Welcome to another episode of Break Away from the Rat Race. And today I have the pleasure of speaking with John Ensley. John is leading a financial planning revolution to help you take back control of your money, your lifestyle, and your retirement plan. John believes ordinary financial planning is failing too many Americans because too many Americans are falling behind. After losing almost everything during the Great Recession, John became obsessed with finding safe, predictable ways to save and create wealth, and also protect you from the chaos and corruption of the conventional financial system. So, John, welcome to the show.
Eric, thanks so much for having me here. I'm super excited.
And what a timely way to meet, because this week there was a bunch of articles that came out. One of them was about Social Security benefit that they were talking about, that they're thinking that in 10 years, they've been talking about it for 50 years, but now they're saying that in 10 years, the Social Security benefit is going to be pretty much depleted or insolvent. And then they expect Congress to spend more money to fluff that up. I know that they're not, it's going to be a tough fight to put more money into the social benefit. So then they talk about millennials potentially having a reduction in social benefit when they get to retirement age. So, I mean, that was a big story. I don't know if anybody paid attention to that, but I'm focused a lot on the retirement side of it and financial freedom, as you know. And to me, that was something that really hit home. On top of that, we hear about China finally, Evergrande, I shouldn't say finally, but Evergrande, a Chinese real estate developer, filed for Chapter 15 bankruptcy in the US. There's also another one called Charity Garden or something like that. I forget what it's called exactly. Another big developer, actually bigger than Evergrande, that is probably following in the same footsteps. Why are we talking about China? Is because a lot of the pension funds, a lot of your pension money and contribution is invested in these companies. And if they default on their payment, well, guess what happens to your retirement? So, John, let's talk about this. Let's get started talking about this conversation, because you're talking about the chaos and corruption of I don't know if I would go as far as corruption, but you tell me, chaos and corruption of the conventional financial system.
Absolutely. It's chaos is a great way to describe it. I would say, yeah, for sure recently, but even over the last, 2 years or so in particular, there's just one story after another with bank failures and, all of these things that have gone on. And so it's definitely chaotic. But even when I kind of went on what I call my journey of self-discovery after the 2008 crash, in that time period, I recognized how chaotic it really was. And I think when I use the term corruption, like you mentioned, when I use that term, I think more in terms of misconceptions, things that people are led to believe are true about the financial system or about some of those tools, and they're not necessarily true. And that was kind of the big takeaway from that journey I went on personally way back when, with hundreds of books and all the studying, was just waking up and realizing that, okay, so some of the things I thought were true actually aren't.
Yeah, it certainly feels a little bit like corruption when you're looking at what happened in 2008 with the loans that were going on. You look at some of the banks failing and having made some appears to be very poor decisions in terms of how they invested their bonds portfolio to protect the asset. I mean, Silicon Valley Bank is one of them, but this week we heard of Schwab also having almost the exact same situation, where everybody is predicting that the Fed is gonna raise the interest rate, and then they go and lock in these bonds for 10 years. I mean, that doesn't seem like a lot of sense. Yeah,
exactly.
A little corrupted.
And that's what I mean by corruption. I'm certainly not suggesting conspiracy theories or anything like that, right? Just kind of the general attributes of that system lend themselves to some misconceptions. And I think it's hard for the we'll call it the normal person out there to correlate what does all this mean to me and my life and my finances, right? How does a financial problem in China circle back to me somehow? And in fact it can, right? Because it's also interconnected now. Your little local bank may be connected to a bank who's connected to an investment company who's connected to, that's now connected to this Chinese bank, and it all trickles down and can have an effect on you personally. And then, so for me personally, that's kind of what I was looking for way back then was how can I build some barriers? How can I create some systems to protect myself against these things that seem largely out of control? Yeah. And, as you know, my financial planning practice is very insurance centric. I'm a bank on yourself professional is what it's called. So I work with cash value life insurance and fixed index annuities and things like that as part of the tools. Because those are the things that I can create some barriers with.
Yeah, exactly. I mean, and there are a number of tools. I mean, I know that cash value life insurance is a good one. I also do real estate. I think it's also an excellent one. There are other tools as well that you can use, but it's really above the tools, like everything else, right? It's not just the tool. It's to basically have the systems and the discipline to be able to organize your finances. Like, people don't seem to be able to organize their finances in a normal way to protect themselves, create wealth, and be ready for retirement. So what are some, I think you do have some systems that you're using for that. I mean, maybe you can tell us more about it.
Absolutely. So there's a few things I like to cover with anyone as soon as I meet them, if they're interested in working with me. And the first thing I like to talk about is what I call the marketing messages. And we have to be careful that we're not making our financial decisions based on just on marketing messages. We're making them based on actual analysis and numbers and how it relates to our own life and our own objectives. Because there's a lot of marketing messages out there. This is bad or that is bad. And I like that we're using the word tools, because all of these things, whether it's an approach to real estate investing, a life insurance policy, a 401k, a brokerage account, these are all tools. And when we use the right tools for the right purpose, we can create some good experiences financially for ourselves. But there's so many marketing messages out there that say this tool is bad, that tool is good, this tool is bad, all of these things. And we have to recognize them for what they're for. They're marketing messages. I often share the story about Thomas Edison. He's a famous inventor, invented the light bulb. He's kind of an American hero. And so I always pose the question, why was Thomas Edison in 1903 electrocuting an adult elephant on camera? Well, he was in a head-to-head battle with a guy named Nikola Tesla over which system, direct power or alternating power, was going to go into the Niagara power plant. So it was a marketing message trying to prove that AC power was too dangerous to use so that he could get his system, DC power, into the power plant. Tesla won that argument, and ultimately the whole world runs on AC power. But we're surrounded by marketing messages all the time, and we really just have to cut through the noise and think critically for ourselves, do the analysis, look at the numbers, and decide what makes actual sense. I like to start there.
Yeah, so let's talk about that. Let's talk about what are some of these marketing messages and misconceptions?
Absolutely. So one of the first ones that I think is super important to understand is what I call the average rate of return con. And you can do a Google search anywhere and find out that the S&P 500, if we'll use that as the example, has a average rate of return of about 9% over the last 30 years. Okay, that statistic is quoted all over the place. So Eric, let me ask you, if we put what do you think that means to most people when they hear about it? If you think you put $1 in the S&P 500 30 years ago, what do you think most people assume 9% means?
I think that means that on average, do you think they made like 9% return every year for the last 30 years?
Exactly. Most of us believe that if I put $1 in 30 years ago, it should be worth about $13 and some odd cents today, if it grew 9% compounded annually. So here's the problem, though. Let's use this example. Let's say that you were the advisor and you convinced me that you could grow my money, and I give you $10,000, and this year you invest it and you double my money. You go from 10 to 20,000, a 100% return. Okay. So I'm happy, you're happy, everybody's happy. Next year, we don't do so good, unfortunately, and you lose half my money, a negative 50% return. Okay. So I started with 10,000, you grew it up to 20, and now I'm back to 10. Okay. If I do the average, the math on that over 2 years, I had a plus 100, a minus 50, leaves us 50 divided by the 2 years. That's a 25% average rate of return. Okay. But am I very happy about my 25% average rate of return?
No.
Probably not, right? Because I didn't make any money. And actually, if we think about fees and taxes, I'm probably worse off than I've been when I started. And so this is what happens when we think about this 9% average rate of return. We have this idea in our head that's what we're gonna compound for the next 30 years, and we're gonna turn that dollar into 13. But the reality of that is very different. So what's happening there, the reason it doesn't work is that all it is when you hear those statistics, it's not necessarily that the money grew by 9%. It's the average of the ups and downs of the index is all it is. It has no correlation to actual money in that index. And the reason for that is the sequence or the order of those ups and downs make a huge difference. And that's why there's no connection there. So that's one of the first misconceptions I like to talk about is we have to be very realistic about what is possible with whatever tool we're using. If we go into it expecting a 9% year over year compounded return, we're probably going to be disappointed because it really doesn't work that way.
What metric? So on this case, so I agree with you totally. I mean, it's kind of like one of those math things that makes it look good on paper, and then it seems so logical, but then when you look at it, then it doesn't really add up, and then you're spinning your wheel as to why. But why? So what is the metric then for the last 30 years? What is the average rate of return on the stock market, the S&P 500?
So there's a lot of ways to look at that. There's an independent third-party research company called Dalbar, and every year they produce a qualitative analysis of investor behavior. They've been doing that since 1984, I want to say. And so most recently, that report says that the average equity mutual fund investor is getting about just over 4% over the last 30 years. And that report also says that the average asset allocation type investor has been flat, and income investors are down. They're down 1 point something percent. Yeah. So you could use those metrics to say, but what we have to remember is it's a very individual thing. If everyone just bought indexes, then we could put some metrics together and decide what worked and what didn't. But it depends on what you bought and when you bought it and when you sold it, and those kinds of things all play into those results. So we just have to be careful when we're comparing tools that we don't look at something with maybe a 5 or 6% long-term growth rate and discount that because we think we can get 9% or 10% or whatever that number is with this other tool over here. So we need to make sure those numbers make sense.
Yeah, exactly. And I think one of those things too is, I don't want to go too deep into this, but yeah, a lot of people are using this 9% return. But if you have that 9% in the 401k, that's great. It's tax free. But when you're withdrawing it, then you're going to have to pay fees to get it out. That's one aspect of it. And then the other thing too is that the timing is also very important on when you're taking the money out. So that's something else to think about. I mean, if you start taking the money out on a down year, then it doesn't matter how much money you made. It's just like, you're going to have to potentially eat in your capital if you're using that 4% asset withdrawal method.
Yeah, it goes back to that sequence conversation, right? Once you start drawing income out of a portfolio, those sequences of returns can have a huge impact both directions, depending on the timing of it. A big crash early in retirement can have a devastating effect later when the money runs out. Whereas a big spike early in retirement can actually, cushion things later on. So the sequence of those returns is super important.
Yeah.
And that kind of brings me to the next one that I like to cover, and that's
Perfect.
the
That's what I was about.
Okay, perfect.
I was
Good.
about to prompt you for that one. Very good. Yeah.
Good. And so kind of along the lines we were just talking about, the pre-tax contribution con, the idea that we can contribute to what are called qualified retirement plans, 401ks, IRAs, things like that, on a pre-tax basis, and that somehow that creates an advantage because we're not paying tax now, we're letting the money grow tax-free, et cetera. But the problem with that is the whole thing operates on the assumption that you're going to retire with a lower income or be in a lower tax bracket than when you were working. The Society of Actuaries will tell you very clearly on a couple of their publications that there is absolutely no difference if the tax rates are equal on both ends. It's the same percentage of income that you're paying in taxes and that you're keeping. So there's really no advantage there unless you're having a lower income. In my experience as a financial advisor, I work with a lot of people that are just at retirement or just into retirement. It's just simply not the case that they have lower incomes.
Yeah.
Sometimes it is, but quite often it is not, because they have other income sources, rental real estate, for instance, or pensions, or they have these other forms of income. And the part that doesn't get talked about as much as it should is taxes on the Social Security payments. We just had the conversation here about the how underfunded that is. So I'll stay away from the whole discussion of whether Social Security is even going to be there for certain generations. But even if it isn't, the way it's taxed, the other income you have will determine up to 85% of your Social Security payments will be taxed, and they use half of those Social Security payments to make that determination. So they kind of change the rules once you retire and start drawing those Social Security payments, which means it pushes a lot of people into as high or higher a tax bracket than when they were working.
Yeah. The other thing too is that when you put your money into these retirement accounts, you're restricted on what you can invest in. So if you're on a regular like Schwab or kind of like these kinds of account, the regular custodian, you can only invest in the stock market and these kinds of things. But you can't invest. It's harder to invest if you want to invest in real estate. Then you have to move to another 401k custodian or retirement custodian in order to do that. And then you have a whole bunch of restrictions and stuff like that. So that typically, if you just stay with the regular custodian, I mean, and you pay the fees and all that kind of stuff, your return may not be as high as you could outside of that 401k.
Absolutely. I'm a big proponent of building up a pool of contingency cash, which is what I like about cash value life insurance.
Yeah.
And then using that cash to facilitate alternative investments. Real estate is super common to use policy cash values to buy real estate, but it really would work with any investment. You could start a business, you could invest in a business, you could buy, if options is your thing, you could do options, it's a platform to facilitate those alternative investments, which I think if you really do realistic analysis are so superior to the qualified retirement plans that it just makes sense to kind of, not that you have to eliminate it, but minimize where you go with that tool, because it's also opening you up to a tax problem later in life potentially. And use some of these other tools to focus on alternative investments where you have a lot more control. If I could describe what the way I describe this whole bank on yourself concept, it's really a philosophy, a financial philosophy that focuses on safety, control, and passive income. That's really what we're trying to do.
Yeah. No. I agree. I have that, and the nice thing about it is that I mean, it's just it's available, and you have a death benefit on top of that. So I like that component of it. But yeah, there's that. I mean, I have a couple of other things too that I do also that have similar kind of self-banking kind of like components as well that I'm using that I'm not going to talk about it because it's pretty obscure, but yeah, so that's exactly the right a good way to do it. Again, good tool. So what's the third misconception that you
So the third misconception is the asset management fees con. And this is one so few people understand until you actually run some numbers with them. Essentially, most people have a 1% or a 1.5% or 2% or sometimes 0.75%, whatever the number is. If your money is in a brokerage account or a 401k or an IRA or any of those types of accounts, somebody is managing that, and they're probably charging you a fee to do so. And then I'm not talking about the internal costs of the actual trades that are happening within your account. I'm just talking about that management fee that's going to the asset manager or the advisor, if you will. And so the couple of things. One is the Department of Labor did a study not too long ago, and they did some calculations based on a $100,000 account over 35 years. And a difference of 1% in fees could affect the value of the account by 28% over that 35 years. That's a big chunk. So there's an example I like to use and kind of work through with folks that I work with. And that is, let's say you had $500,000 in a brokerage or an IRA or whatever it is, and you're paying a 1% fee, and that account's going to grow at an average of 3% a year. I know I don't like average rates of return, but we're going to use it for the example. So it's going to grow at 3% a year, 1% fee. Over 25 years, that comes out to $182,000 in fees. And this kind of ties back to, which is an enormous amount of fee to pay someone, particularly if your advisor is, putting you into index funds or mutual funds and really just leaving it there. So the way this ties back to marketing messages is quite often the marketing messages are that some of these alternative tools, like life insurance, annuities, different things, are very high cost, right? So that 182,000 represents a 35% of the original $500,000 amount, or 35% of the growth approximately, and close to 20% of the overall account value at the end of 25 years. I have never seen an insurance product with fees that high. They're structured very differently. So I think it's one of the misconceptions that's super important to understand, because that is not a small amount of money that we're talking about coming out of your portfolio. It's, that 1% is sort of like compound interest in reverse.
Yeah, I mean, it sounds exactly. I mean, it sounds so cheap, but
exactly,
that it does add up. Yeah, absolutely.
So these things that we're talking about are something I refer to as money monsters. They're the things that are kind of silently eating away at that value we're trying to build over our lifetime. And so we've touched on a few of them already here: taxes, fees, crashes, inflation, and debt interest.
So I mean, some of the people are going to say they're going to agree with you and say, yeah, I'm totally on board with that. I think that makes a lot of sense. But okay, so what do I do with that information? I don't take my 401k. I invest in something else. What do I invest in? All that kind of stuff. What's the plan here?
So, for instance, one of the things, if I'm working with someone who has some 401k balances or IRA balances that they can get access to, so maybe it's a previous employer's 401k that became an IRA that they still have, et cetera. One of the things we talk about is you can take a portion of that and move that into something like, let's say, a fixed index annuity. A fixed index annuity, it's still considered a qualified plan. So you can make that transfer without taxes or penalties or any of those things that people are afraid of if they move that money anywhere. It's a custodian to custodian transfer, so that you avoid any of the tax complications. It just moves straight over, still considered an IRA or whatever it is. But now we've eliminated some of the money monster effect on that money. We've taken the market crash scenario out. We've taken the average rate of return con out of the scenario. We've eliminated some of it because if we design them right and we use the right contracts, they're going to come with a guaranteed lifetime income feature, a guaranteed lifetime increasing income feature, where at a certain point in time, at retirement time, because these are retirement accounts, that's what they're for, we can then turn on a stream of income. A stream of income that will beat the 4% rule that most people are familiar with, in terms of a stream of income that is guaranteed for as long as they live. And if we set it up the right way, as long as their spouse lives, no matter how long they live. So we can eliminate that longevity risk. There's some of these things we can do, and I'm not suggesting you take everything and do that with it, but there's a portion that it would make sense to protect, to carve it out, put it into a tool like that, let it sit there and percolate and turn into a pension-like income for you when you're ready to retire and you want a pension-like income.
Yeah, for me, like
so that would be one example.
Yeah, so that's a good example. A lot of people are considering that. These annuities, I mean, when I looked at these annuities, especially when you have the indexed waiver on, the payout on the annuity is around like of course, it depends on the age, it depends on when you're doing it,
a lot of
depends
factors.
on the interest rate the moment you're doing it. There's a lot of variables, and then you end up with a payout around 4 and 5% of the amount, the premium that you paid for the annuity. So I mean, it's good. It's obviously very low risk, because it's very low risk. I mean, the only risk you have is if the company goes belly up, then maybe you have an issue. But really, it's very low risk. But you're paying that risk by having a pretty low payout, I think. But again, it depends on every the particular situation.
Yeah, for sure.
So that's. But yeah, that's a good vehicle for for that purpose. Yeah.
So there was an example of one I just ran recently where a $250,000 premium within let's say 5 years, the way it was structured grows up to 500,000 or so in 5 to 7 years, and then the payout on that was right around $25,000 a year is where it starts. And every time the index gets an increase, that income is going to get an increase. And so it starts there and rises throughout the rest of your life.
So yeah, that's right. So that's right. So there's two portions of the annuity. There's the payment period, the premium payment period.
Yep.
And then there's the payout period. So yeah, if you so that's great. That's pretty good. So
there's of course a lot of other things. I just use that as a very simple, low risk, not something anybody really needs to stress about approach if they're looking for ways to protect themselves.
Yeah. The thing that people were complaining about the annuities too was the fees. There's the fees were pretty high on these on the annuities, the initial fees just to get it set up, and that was scaring a lot of people off.
Yeah, and I think what happens with the annuities is the fees you pay are one time if they're done right. So they're one time on the beginning. And when I run the comparison to that one I just ran through, where 500,000 is 182,000 in fees, which equates to close to 20% of the account value. If I do that same analysis on the income account on an annuity, it works out to somewhere around 3% over the same 25 years. Of the accumulation value. So it's still much lower than what it appears to be. And this is kind of what I meant by the marketing messages, right? There's a lot of information out there. Wow, the fees are really high. But if you actually compare real fees over a period of time, what you'll find is they're much more competitive than the conventional approach.
Yeah. And then, so that's good. And so what's another, so what are some other suggestions that you have to basically safe and predictable ways to create wealth and then really figure out your retirement planning?
Absolutely. So we've alluded to the other one, right? High cash value, low commission, dividend paying whole life insurance is something that I use a lot in my practice as a place to build a pool of capital. And then I think from that point, once you have some capital built up, that's where I think you and I are on the same wavelength, where I think single family real estate is an excellent place for people to begin and start accumulating assets using the whole life policy as a platform to leverage that and make that happen, so that you're getting the gains in the real estate and the gains in the policy value at the same time. So that would be the other one. As I mentioned, my practice is very insurance centric. So those are two strategies that are definitely take a center stage in what I do. Yeah.
And basically you're taking a loan against the cash value of your life insurance. And but the cash is still there in the policy. The value of the policy is still there. The death benefit is still there, even if you take the loan. It's growing normally. It's just now you have a loan against it, and you're basically using it as collateral, and then you pay the loan as you would normally, and then you can invest. It helps you invest in real estate, but nothing changes. It still grows the normal way on the life insurance side of things.
That's correct. And that's because the insurance company is using the life insurance policy as collateral. So it's a non-recourse loan. Number one, the only thing that's collateralized is the policy itself.
Yeah.
And what they're doing is they're taking the cash value you have in the policy, and that's the limit of what they will loan you. And they're using the death benefit as the collateral. So, insurance companies are highly regulated in what they can invest in. And one of the investments they can make is policy loans to their own policy owners. So we become part of their overall portfolio of investments with the policy loan that we take. We pay them some interest. It's with most companies, it's simple interest, and it's only applied once a year to the policy. And I won't go into the details, but that makes a big difference. The average effective rates on a policy loan, depending on how long you take to pay it off and how much you're paying back, will range anywhere from an effective rate of 2% a year to 5% a year, somewhere in there. So particularly now, it's a very low cost financing option.
Yeah.
And then, as you mentioned, because you're not actually taking any money out of your policy, you're borrowing it from the insurance company with your policy acting as collateral. The values in your policy continue to grow at the same pace they would have whether you borrowed the money or not. So you have two sides of the same coin. On one side, it's very low cost financing, 2 to 5%. On the other side of the coin, you're still accumulating guaranteed growth and non-guaranteed dividends within those policies at the very same time on the very same money. So it's a compelling financing tool.
Yeah, no, absolutely. So I think that's if you have a good if you have a good life insurance policy, and then you can borrow from it with cash value. I think it's a great way to do it. Find some money and then and work with it. Any other advice you have for people that are, because one of the big things that people have right now is that they don't have they haven't saved enough money to they're retiring. There's 50. So I think the latest one that I've seen is that people age 55 to 65, the median retirement saving is $134,000.
Yes.
I heard a number from Vanguard. It was even much lower than that. It was less than $100,000. So don't wait till you're 55 to 65. So what can people do if there are early Gen Xers or millennials? How do they get prepared for retirement early?
For sure. I think, I think this comes down to really some very fundamental personal finance approaches, right? You talk about a lot on your shows. So, obviously everyone has to have an income. It's enormously more difficult to create an income from nothing. So usually you start with some kind of income, and then it's a matter of living below your means, and not just below your means, but well below your means. I know you talk about the 50-30-20 approach. Yeah. And I think that's a great approach. For me, I don't really care what percentages people use, but have a plan, right? Whether it's 30-50-20 or 50-30-20, or however you do it, structure it so that you are budgeting your living expenses and the other expenses you may have, and saving and investing, right? You have to have those three categories. The percentages might vary depending on your circumstances, but have a plan and live below your means. One of my favorite books of all time is the Babylon, the title just escaped me. The Richest Man in Babylon book. Yeah. Because it covers these things in such a simple way, right? Manage your income, live below your means, stay out of debt, those kinds of things. Debt is another big one.
Yeah, that's right. Let's talk about debt, because I think that there's a lot of misconception around debt. Debt is bad, and but yeah, not all debt is bad.
Not all debt is bad. I agree. What we have to be careful of is the interest we're paying, and too often we get caught up in what the rate is without thinking about what the volume is on that debt. Obviously, credit cards is the numbers on credit cards in the United States now are mind-boggling. But at 20% interest, a $10,000 balance is at over 10 years is $20,000 just in interest. It's double what you actually borrowed just in interest. And I can't tell you how many people I meet that have credit cards with balances that they really can't tell you how long they have had those balances, right? It goes years and years and years. Even a mortgage, a $500,000 mortgage at what might be now an 8% rate over 30 years is close to $700,000 in interest if you let it go that long. So it's really about time.
Yeah.
Again, that sort of compounding in reverse effect. One of the ways I like to describe debt, at least this kind of debt, is that we're essentially grabbing resources from the future and pulling them into the present to create something that we don't have the money for now.
Yeah.
And that can be a profitable strategy if you're investing in something, if it's a real estate deal where you're borrowing money and you're creating cash flow from that piece of property or that business or whatever it is. But it can be hugely destructive if it's a car or a boat or things like that, where that interest is just eating away at future resources. And what happens when it gets out of control is you get to the future and all the resources have already been sucked into the past, and you're bankrupt.
Yeah.
So we just have to be super careful with that. And it's the volume of interest. It's at 700,000 we have to pay attention to, not that it's 8%. 8% doesn't sound too bad. 700,000 is a huge amount of money.
Yeah. Yeah, exactly. I mean, I think this is exactly right. I mean, you kind of like you're borrowing from the future. So that's why you want to have something that is going to generate some revenue somewhere along the line. It doesn't have to generate revenue like right away. I'm a big proponent of cash flow, positive cash flow throughout. Other people are going to say, well, I'm going to have no cash flow for a couple of years, and then I'm going to have a big bang after 2 years or 5 years or something like that, when you do value add on some larger assets. But I prefer to have the cash flow. I want to make sure that at least it pays for itself, and then I have a value add component at the end as it appreciates over time. So that's that's my philosophy, and I do that for everything. I do that for looking at buying a yacht, and I'm looking at it the same way. It has to pay for itself. It drives my family crazy, but if it doesn't pay for itself, then we're going to charter it, blah blah. If it doesn't pay for itself, we're not getting a boat, and it's going to pay for the loan. It's going to pay for everything, and when we're in Fort Lauderdale, so we should be able to charter it and make some return. I'm not asking for a huge amount of return, but it has to pay for itself. Otherwise, it's cheaper to just charter the boat when I want one.
Yeah, absolutely. I love that you said that. I'm an avid sailor, a licensed captain and a sailing instructor, and it's been another passion of mine for years. And I look at it the same way. I got my captain's license and became an instructor as a way to be able to generate revenue from this thing that I love to go do. So similar concept. It has to pay for itself. It has to create some kind of revenue stream to offset the cost. Otherwise it doesn't make sense. And it's so healthy to look at as many aspects of your life that way as you possibly can. Yeah,
exactly. You look at it and you say, okay, well, I mean, it keeps you pretty frugal, and then at the same time you can find situation where you can actually get what you want, and it makes money for you on top of that. So it's just like when that happens, it's pretty phenomenal.
Absolutely. So I actually run through a scenario with folks on yachts where we use the bank on yourself policy as a financing tool to put a yacht in charter, and it works out pretty interestingly. Yeah,
and unfortunately, my cash value on life insurance is significantly lower than the value of the yacht.
The cost of the yacht. Yes, that's often the situation.
So I would have to increase my my policy dramatically for that to happen.
Yeah.
So John, what's the best way for people to reach out to you if they're interested to learn more about kind of like your systems, and then kind of how to they found something that's interesting and they want to connect? What's the best way to reach out to you?
So I've set up a landing page just for that purpose. It's called jumponwithjohn, JOHN.com. And you can hit that page and jump right into my calendar and schedule a free strategy session. So you can get 20, 30 minutes of my time, or we can just have a conversation about, what it was that caught your interest in our conversation today, whether we're a good fit. That's really what it's about. It's not really a sales pitch. It's more determining whether it's a good fit. And then we can go from there. So it's jumponwithjohn.com, and you can schedule a time when we can have a chat and do that free strategy session.
Great. Well, thank you, John. It was a pleasure.
Thanks, Eric. It was a fun conversation.
Yeah, talk later.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.